Okay, my mic was muted. Hey guys, can everyone hear me clearly? Right, I can see we got Chris, got Fletcher, got Frank, Claude, right? Nicola, right? Can you guys hear me clearly? All right, I've opened this thing called the webinar chat and sent a message to you guys over there, right? What I want to encourage you guys is that if you can, try to send a message there so that I can see whether it works. Yeah, so that I can see whether it works and if you guys can hear me clearly. Loud and clear. All right, thank you, Fletcher. Okay, you can see me, you can hear me, and that's good stuff, right? In today's session, right, it's our weekly Monday session. We actually focus a lot more on the fundamentals, like what are the key news events and setups that you need to watch out for the week ahead. Okay, and I see a whole bunch of you guys coming in. What I want to encourage you guys is because, you know, we are going to cover news by news, instrument by instrument. So when you have questions, ask them right away. You know, don't wait until the end of the session, right? Otherwise, you know, sometimes we don't have enough time or the questions get lost, right? So ask your questions right away. We do our best to answer them. Okay, so yeah, today's session will be presented by Ketan, right? He's one of the newer members of Everest Fortune Group. You guys have seen us for a long time, right? And he's really, really good with fundamentals, right? And be really diving deep into not only the key news events for the week, but also his own personal take on them and how he does his research when he's reading up about them. Okay, so take this opportunity to really pick his mind, right? Get a better insight into how he analyzes the markets, right? It's a very, very fun thing to do, right? And if you're tuning in from, just let me see, if you're tuning in from YouTube, all right, yeah, if you're tuning in from YouTube, also feel free to ask us questions. Okay, yeah, I think we are tuning in from YouTube, we're tuning in from a couple of places. Okay, but yeah, breaking news and setups. I'm just going to cover one thing before I pass the time on to Ketan, right? And that is, you know, disclaimer as usual, guys. Remember, everything this webinar is educational in nature. Nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade, right? Yamilu, nice to see you here. Right, remember that we literally have another screen open here, just monitoring the questions coming through. So don't hesitate to ask us questions. Okay, now just let me close this off. All right, now I'm going to pass on the time to Ketan, who will be covering what to expect in today's session. Okay, Ketan, over to you.
All right, thank you, Desmond. Hi, everyone. Good morning, good afternoon, from whichever time zone you're in. All right, so as Desmond has said, we're going to start off, today's session is going to be about breaking news and setups. Okay, so we'll start off, as you can see, the main points that we'll be looking through today, or today's agenda will be oil production cuts, US GDP and inflation data, EU inflation data, and of course, this week we have two central bank interest rate decisions coming up in Australia and New Zealand. Okay, so first off, oil. So this has been the biggest news of the week so far. So last night, Singapore time 10 p.m., which is UTC +8, there was an announcement that Saudi Arabia, along with its OPEC and non-OPEC members, will be cutting their daily production rate, right? So the Saudis will be cutting about 500,000 barrels per day, and all the other members as well, OPEC and non-OPEC, will be following suit. So what this means is we've had a production cut. So we're going to see less oil coming into the market from May onwards all the way till December. And prior to that, earlier last week as well, in the middle of last week, we had supply disruptions in Iraq as well, and Turkey. So we've got two key news catalyst events that have caused the price of oil to spike. So last week oil closed pretty strongly, and this week, today morning when the markets opened, oil gapped up higher and opened above $80. So we've had supply disruptions last week combined with production cuts, which were announced yesterday, that have driven the price of oil up. Okay, next we will look at weekly stocks. Okay, so this is the EIA inventory stocks for oil. So generally, when you see the inventory being drawn down, is what we've seen from middle middle of 2020 all the way to 22. It means that oil demand is strong. So as when oil demand is strong, we can expect the inventory to be drawn or to be reduced. And then similarly, when conversely, when inventory starts to build, generally we can assume that oil demand is low. So when oil demand is high, naturally we would expect oil prices to rise, and conversely, when oil demand is low, we would expect oil prices to pull back. Okay, so this is the weekly chart of WTI. So as you can see, if you can just imagine when 2020 after the pandemic hit, and as crude inventory began to draw down, oil prices also had a good strong uptrend move. So generally you can see it's combined with factors such as reopening factors, which cause oil demand to increase, and you can see that in the inventory stocks, weekly inventory stocks. As you can see, inventory stocks pulling down or being drawn down. You can see the oil price move up, rising quite strongly over the long term. So you can see this was a very bullish phase for oil, or period for oil. Of course, along the way, you will have pullbacks and consolidations, but generally you could see the uptrend in oil was very clear and backed by fundamentals such as the drawing down of the weekly oil stocks, crude stocks. Okay, and of course, what we saw in February 2022, we had the invasion of Ukraine by Russia, which spiked oil prices as well as other energy and agricultural products as well. So in order to combat high oil prices, what the US government did was they authorized the use of their strategic petroleum reserve. So by doing that, they were actually releasing barrels from their strategic reserve into the open market. So from June till November of last year, they had actually released about 180 million barrels of oil into the market. So what this does is when you have an increased amount of supply coming in, it forces prices down, right? With consumption and demand being relatively stable, but with having excess supply coming to the market, it has actually forced the price of oil to come down, which is what the US government wanted, because they were combating inflation. So inflation was a big problem for, I would say, all countries last year, whether be it energy prices, agricultural prices, food prices, housing prices. So inflation was the highest priority on everyone's mind last year. So by releasing barrels of oil from the SPR, they were able to force down the price of oil in the open market. So you could see from June to November, oil was clearly in a downtrend. So this would have been, by understanding the fundamental news and catalysts behind it, you can understand where oil is headed, and then you wouldn't want to be long oil here. Of course, there's instances where you could have short covering and good bounces in oil, but generally the trend for oil was down, right? This is a very bearish move down. So you'll be looking to short this market based on technical analysis, be it on your preferred time frame. It could be a daily time frame or 4-hour time frame, for example. So then what we had was a period of consolidation where there was no real catalyst, because over here in November, that's when the last of the barrels from the SPR was released, and there was no real catalyst for oil, be it bearish or bullish. So it was consolidating between $70.20 and about $83. And then 2 weeks ago, when we had the banking crisis in America, the regional banks, plus the Swiss banks as well, with Credit Suisse, sorry, but not the Swiss bank, just one bank from Switzerland, the Credit Suisse. So because of that, it sparked recession fears, which caused the price of oil to drop. Okay, recession fears, basically once you the potential or probability of recession increase, economic demand weakens, people lose jobs, unemployment rates rises, so thus the demand for oil drops significantly. That's why we had this big drop in the price of oil over the last 2 weeks as well. But what we've seen recently with the supply disruptions in Iraq and Turkey, coupled with the the announcement of production cuts by Saudi and its OPEC and non-OPEC members, oil has actually bounced very strongly from as low as about, I'll probably say about 63 all the way to today's open at 82. So let's just look at the the current chart rather. Okay, so this is, okay, now we shall look at, okay, right? Okay, so this is this weekly chart for WTI. Oh, sorry, no, this is not a weekly, this is the daily chart for WTI. So as you can see, oil gapped up today at the open at about, just above $80. And it went as high as about 81.60. It's been, after that, it's just been pulling off slightly. So currently, you can see the price of oil is in between our first resistance and first support. So our first resistance level is at about $83.26, and first support is at about $70.24. So given the backdrop of oil with regards to production numbers and supply disruptions, we can expect to see oil remain pretty bullish for the rest of this week. So these are some of the key levels to take note of for oil, and also bear in mind the latest news events that have taken place. Okay, now we shall go back to our slide. Yeah, let's go back to our slides. Okay, we shall move on to some of the news from the major economies last week. So we will start with the US, where we had the third estimate or the final reading for the fourth quarter GDP numbers. So GDP grew at an annualized rate of 2.6% in the last quarter of 2022. So after experiencing technical recession in the first half, the US economy has bounced back quite strongly. And also for Q1 of this year, 2023, the estimate for GDP for the first quarter is about 2.5%. So we are seeing relatively strong growth in the US, and this looks set to continue into Q2 as well. Next, okay, we also had the PCE Price Index data, which was released last week on the 31st. So the PCE Price Index is the Federal Reserve's preferred measure of inflation. So, okay, this is a table. It might not be so easy to visualize what's happening here, but I'll show you the charts in the next slide. So basically, looking at the headline PCE reading, it has dropped on a monthly basis. It has dropped from 0.6% to 0.3% in Feb, and the core reading has dropped from 0.5 to 0.3% on a monthly reading. So that's good. Moving forward, it looks like inflation is easing in the United States at the headline level and core level. And looking at the annualized readings, they are also trending lower as well. Okay, so the next slide, we will see it's easier to visualize. So on the first graph on the top, we see the headline PCE reading, while the second graph at the bottom shows the core reading. So headline PCE peaked at 7% in June of last year and has moderated quite strongly down to 5%. Whereas the core PCE reading peaked in February of last year at 5.4%, but it's actually not made as significant moves down as the headline reading has. So as you can see, energy has, the drop in energy has helped to lower the headline reading, whereas the core is still pretty sticky. So looking at this overall, I think we can expect the Fed or the Federal Reserve to be not so hawkish or aggressive in the upcoming meeting or for the upcoming FOMC meeting. Okay, now we'll look at EU. Okay, so we had the flash estimates, CPI flash estimates readings released last week as well. So on an annualized basis, the headline CPI reading dropped from 8.5% to 6.9%. That was quite a big drop, so that was a good sign. But however, the core CPI reading is still very sticky. It actually increased on an annualized basis from 5.6 to 5.7%. Okay, so on the next chart here, this is from the ECB. So they had recently released a slide deck on the 29th of March. So this presentation was released prior to this flash estimates. But as you can see, the Euro area headline reading from 8.5%, which was the previous one, has dropped pretty significantly to 6.9, which would be somewhere around here. Whereas the core reading of 5.6 has edged slightly higher to 5.7. So looking at this and the yellow line is showing is comparing it with US inflation, the headline inflation and core inflation. So as you can see, for both the US and EU, core inflation is sticky. So what do they mean by sticky? Sticky means it's being stubbornly high, right? It's not moderating as fast as it should with respect to the headline figures. However, US inflation does seem to be pulling back faster than the European Union. So I think moving forward, you can probably expect the ECB to be more hawkish than the Federal Reserve. Okay, and here we have the charts breakdown of the individual components that make up the CPI reading. So as you can see, in red, the energy components have been dropping pretty significantly, especially for the US. So that has helped to reduce overall inflation. But however, you can see the US services are now making up a big part of inflation. So the trend in the US now, at least economically, services is a large driver, and so we can expect the services sector to remain relatively sticky. And for the Euro area, overall, all the components seem to be progressing or at least reducing at about the same rate. Okay, we also had unemployment figures released for the European Union last week. So that was also on 31st of March. As you can see, unemployment rate is at 6.6%, which is relatively low. So employment figures are good in the Euro area, and we can expect decent GDP growth as well. Okay, next we'll look at China. So China released its PMI readings last Friday as well. So after being in a self-lockdown for most parts of 2022, you could see there's very little manufacturing activity and services activity. But now that they have reopened, they have bounced quite strongly. So manufacturing PMI numbers are increasing, while services have joined them as well. Services seem to be leading the growth in the China economy at the present moment. So with China fully reopening now, we can expect more demand from them. So in terms of commodities, it is very likely we could see stronger demand coming from China with regards for like iron ore or copper and other industrial metals, as they have now as they have now fully reopened and have kickstarted their economy. So what does this mean? So recently I've seen I came across a news article where they were looking at copper stockpiles, so global copper stockpiles. So the charts here showed the level of the stockpiles across the various years, so from 2019 all the way to 2022. And then also for 2023, they have the projection of where they expect stockpiles to go. So what this is telling us is they expect stockpiles to dwindle quite strongly in 2023. So what this means is there's a lot of demand. Okay, sorry, there's a question here. Okay, yes, let me see if I can. Okay. Okay, PMI is okay. Right, there was a question. Okay. All right, okay. So there's a question about PMI. So PMI stands for Purchasing Managers Index. So these are basically monthly surveys that are sent out to various industrial corporations, be it on the manufacturing, or not only industrial, but companies in the manufacturing and services sector. So the surveys are done on a monthly basis. So this surveys are done not only in China, but also in Europe at a Europe-wide level, as well as the individual countries, and of course for the US as well. And also there are countries that take part in the in such surveys as well. So these surveys give an indication or insight into the state of the manufacturing and services industries of that particular country. Right. Okay, let me see if there are any more questions. Okay, I don't think so. All right, so I shall continue. So basically what this chart here is telling us is there's expected drawdown of a strong drawdown of copper stockpiles, which would mean that demand would be strong. So when you have a stockpile that is dwindling, while demand could be strong, you could expect copper prices to increase. So at the end of the day, to put it simply, it's just supply and demand. And when you have strong demand with limited supply, you have more people or companies fighting for that same finite amount of resources. So when you have finite resources and a strong demand, you can expect prices to increase. Any more questions? Right. Okay, so let's look at, So let's look at copper, the copper chart. So as you can see, this is the weekly chart for copper. So there's, of course, copper prices are influenced by many things. One of them would be demand for the metal itself, be it for industrial users, especially for in the EV market as well, and for any green energy users. So there's a lot of demand for copper from that, and also the price of the US dollar also makes an impact. So when we had the US dollar rising strongly in 2022 all the way to the middle, you could see it had affected the price of copper quite significantly as well. And then in the second half of the year, when the US dollar started to weaken all the way till the end of the year, you could see the demand, the price for copper started to rise as well. So there's several factors that play a part in the price of a commodity. Demand and supply would be one of the main reasons, and also the strength of the US dollar itself. Yeah, let's just look at a live chart of copper. Right, so let's go copper here. So as you can see, this is a daily chart of copper. So given the background where Goldman Sachs is expecting copper stocks to dwindle, we would think that that potentially there's a not high chance, potentially there's a how do I phrase this? There's a strong possibility that price of copper could rise beyond its current levels, but that doesn't mean we just take a position and buy the instrument immediately. So some of the levels to take note of are on this daily chart is 3.8 $3.89, and $4.35. So these are the two major resistance and support levels. So once, given the backdrop of potential demand for oil, copper, plus if the US dollar remains relatively stable or continues to weaken, there's a good chance for copper to be potentially be bid and make a move up. So this is something to just take note on a bigger, on a larger time frame, and also to just understand the background of why we think there's a potential for copper to have a good chance to move higher this year. Go back to our presentation. Okay, so next we'll look at credit spreads and volatility. So as we have seen recently with all the bank turmoil in the US and Switzerland, there's a lot of volatility in markets, and also how do we try and determine how bad the financial markets are, right? So basically, FRA-OIS spreads, basically these are just forward rate agreements and overnight index swaps. Okay, these are pretty technical terms, but it's not so important to know what they actually mean, but it is important to understand how to read this chart. Okay, so when we want to know how bad or how stressed the US financial markets are, and one way is to visualize and to understand is by looking at this spread. So as you can see, when in 2008, during the great financial crisis, this spread actually skyrocketed to more than 175, to a reading of 175. And during the recent pandemic lockdowns, it went as high as about 80. So basically, when this spread increases, what it is telling us, it means that what it is telling us is that financial stress in the financial markets is increasing. Right, so this is what we saw exactly at various points last year, and also this year here when we had the regional banking crisis with SVB in the United States. So this is about a 12-year chart, but let's zoom in on a 1-year chart. So you can see the index, the spread peaked at 60 and has started to come off. So what this tells us that although the financial markets were experiencing a pretty high level of stress in recent weeks, they've actually started to come off now. So all the measures that the Federal Reserve has done to take to mitigate the issues surrounding Silicon Valley Bank and all the other regional banks in US, it seems to be working, and the financial stress in markets are reducing. So although volatility is still relatively high, but we can see that market conditions are improving. Okay, now we are going to look at the VIX and the MOVE and some other stress indicators. Okay, so the orange line here, MOV, MOVE, is the equivalent of the VIX. So the VIX is an index that measures how volatile the S&P 500 market is, and the MOVE is the equivalent for the bond market. So you can see bond markets have been very volatile this year and for most parts of 2022 as well. And also we can see this is these charts are presented by the ECB. So we can see they have an indicator for systemic stress as well. So for 2022, generally there was high stress in Europe, but after that, in the third quarter onwards, the indicators have started to drop, and similarly for the US as well. So, and then after that, because of the banking issues in Switzerland and US, they have risen again. So they're historically not as high as what we've seen in the pandemic era, but it is still they're still relatively high compared to 2021. So we are in a period of high volatility for both equities and the bond markets. Okay, next we shall look at US equities. Okay, so what are financial conditions? Okay, so here we have two indices. One is by Goldman Sachs and the other one is by Bloomberg, which gives us a reading of the financial conditions of the US. So financial conditions, some of the components that are used to determine financial conditions are bond yields and the strength of the dollar, so the DXY. So as you can see, when the Federal Reserve was raising rates in 2022, financial conditions begin to tighten. So as for the Goldman Sachs index, a reading above 100 means financial conditions are stressed. So as you can see, they started off at a base of about 97 and it went as high as 100.5, sorry. So as bond yields were rising, the dollar was strengthening and the Fed was aggressively raising interest rates. You could see that financial conditions tightened. So when financial conditions tighten, asset classes such as equities tend to suffer. So that is what we saw clearly. So that is when the S&P 500 and Nasdaq started pulling back and going into a steep correction and even a bear market as well. And towards the third quarter, from the third quarter onwards, financial conditions actually peaked and started to ease. So that's when we saw the strong bounce in US equities from the third quarter onwards all the way till this year. So as financial conditions loosen, it had actually helped to spur the rally in US equities. So this index on the right is by Bloomberg. It's calculated differently, but basically is telling you the same thing. So when the reading is above 0, it means financial conditions are loose and equity markets generally tend to do well. And when financial conditions tighten, for this case, this index, when it goes below 0, that's when it is negative for US equities. So in this chart here, we are looking at the weekly chart for the US 10-year bond yields and the S&P 500. Okay, so as you can see, in 2022, when the Fed was raising rates aggressively, bond yields were rising strongly, and the dollar index DXY was rising as well. So this was a good time to go long the dollar versus most of its counterparts. And this is when financial conditions peaked, right? So if you look around here, this would be the period where financial conditions peaked. And from here onwards, bond yields started to fall and the dollar index fell as well. So DXY has fallen quite aggressively as well. So when these two asset classes are falling, generally, it will help to spur a rally in equities. So this is what we've seen. So from as low as 3,600, although it's a bit choppy, but the S&P 500 has rallied pretty well to go to reach about 4,100. Okay, so now we are looking at market breadth. So what is market breadth? Market breadth is looking at the percentage of stocks in the S&P 500 that are trading above their 200-day moving average. Why is this important? Because this is important because it tells us whether the rally in equities market is broad-based or is it only limited to the large cap companies. So when you have an instance like this, when the market breadth is above 50%, it means that majority of the companies from small to large cap are driving the main index higher. So this is a healthy stock market where you have your large caps such as Amazon, Apple, Microsoft, pulling the market, driving the market higher together with the smaller and medium-sized companies as well. So recently, the rally has been accompanied by was pretty broad-based. As you can see that the number of stocks trading above 200-day moving average reached as high as 73%. So the S&P 500 generally, and we can just summarize that majority of the stocks have helped to push the market up, to help push this index up. However, if we were to look at the Nasdaq 100, although the Nasdaq 100 has rallied very strongly, the market breadth is actually pretty low. So this implies that this move in the Nasdaq 100 is led primarily by the large cap or the mega cap tech stocks. So this would be Apple, Google, Meta, Amazon, Microsoft. So this is not a very healthy indication of the Nasdaq 100, because this would mean that many of the smaller and medium-sized companies are not the share prices of the smaller and medium-sized companies are not rising, and it's only the mega cap companies that are pulling the index higher. So generally, this is not a very healthy rally for the Nasdaq 100. So if you just look at the charts for the S&P 500, we'll go. Okay, so this is the US 500 instrument. So this tracks the S&P 500. So as you can see, yes, okay. So this was the low in October, and generally the S&P 500 has made a decent bounce off this low as financial conditions loosened. So as the dollar index weakened, bond yields started to fall. It has spurred a rally in the S&P 500. Of course, there has been pullbacks along the way, but you can see how the dollar index and bond yields and financial conditions drive the US market. I mean, these are not the only conditions that will drive US equities, but these are just some of the components that play a part. Okay. Oh, sorry, there's a question here. Okay. Question here from Idris. Okay. Where do we have those information? Okay, so which so okay, I'm just basically Idris, okay, which information are you specifically looking for? Because we've covered quite a few things, from inflation to GDP, and also this, if you could just tell me specifically which piece of information you're looking for, I can probably get back and help you out. Inflation. Okay, so inflation and GDP. Okay, sure. Okay, since we are here, okay, so I'll just wrap up the US 500 first, and then we will show you guys how to look for the inflation data and GDP data. Okay. So this is a daily chart of the US 500. So just a few things to take note of. We have an intermediate resistance here at about 4,100, and the first resistance would be the swing high about 4,200 here. First support is at about 3,990. So these are some of the resistance and support levels to take note of for the S&P 500 for this week. Okay. All right, so now, okay, I shall show you. Okay, right. Okay, so if you go to Forex Factory here, okay, so this is a site that has a economic calendar. So if you just Google Forex Space Factory, right, you can see my screen. If you Google it, it will be it will be the first results. If you click on it, it'll take you to their website, and they have an economic calendar where you are able to see all the news events from various countries. Okay, so let's do a period. So for last week we had let's see, hang on, yeah, 27, 31st. Oh wait, yes. Okay, so we're going to look for last week's economic calendar, and then we'll also filter it. So you can filter it with various components. So normally I will take the first two here, the red and the orange, because this would have the high impact and more important data news, and this would be the currency pairs. So normally I just leave everything else on and just choose the two highest impact categories. Okay, so we click apply filter. Okay, so if you want to look at last week, we had GDP data from the US. So here you can see Thursday, 30th March. Okay, these timings are Singapore timing. So this is UTC +8. So if you look at USD here, your final GDP and final GDP plus other data points as well. If you click on this folder here, it will give you further details of where this information is derived from. So it is from the Bureau of Economic Analysis. So if you click on latest release, it takes you to that government website, and it gives you it takes you to the page where all the news releases are. So if you look at for GDP, which was done on 30th March, and you click on it here, you can have all the information that was presented in the slides earlier. So similarly, if you're looking for PCE, which was done on 31st, so and another good thing about Forex Factory is you can also click on the chart icon here, and you can also see how GDP has performed. Similarly, so on 31st, the PCE inflation data was released, so that was here. So you have core PCE here. So same thing. You click on the chart, you can see the readings here. This would be on a monthly, month-on-month change. And then if you click on the folder here, again, it'll take you to this site. I will give you pop up this window to show you where the information is derived from. And if you click on latest releases, again, it takes you to the same page that we saw. Okay, this one takes you directly to the current release. So you can click on it, and it brings you here. So PCE. So this is what we were looking at earlier. So PCE month on month here, PCE on an annualized basis, both the headline and core readings. Okay. Okay, so now let's head back to our presentation. Okay, so next up we'll be talking about gold. So okay, let's go back to gold. Okay, so gold is, there are many factors that drive the price of gold. It can be actual physical buying by central banks or by industrial companies, and by the strength of the US dollar. But one of, I guess, the ways that I also like to look or to track the price of gold or the direction of gold is by looking at real rates. So what are real rates? Real rates are 10-year treasury yields adjusted for inflation. So, so what we have here on this chart is, in yellow we have the price of gold, and in black we have the inverted chart for the real yield. Okay, so what is important to know that the real yield and gold have an inverted inverse correlation. What that means is if real yields go up, gold goes down, and vice versa. So just be mindful that this chart is actually showing you an inverted chart for real yields, so it's easier to visualize and understand. So as you can see, when this real yield is actually decreasing, so it's going from a positive number to a negative number, so real rates are decreasing, you can see the price of gold going higher. So generally, when you're in this environment, gold will tend to go higher. So once you know where, what is the outlook for gold, on a slightly longer time scale, it will help you to identify trading opportunities on a slightly shorter time frame. So once you know what is the big picture for gold, you are able to use technical analysis, and depending on your favorite time, your most preferred time frame, being the daily chart or 4-hourly chart or hourly chart, you're then able to identify trading opportunities based on your trading style. Right. So in the second half of 2022, or the second half, the start of 2022, when real yields started to go from negative to positive, that's when the price of gold also started dropping. So gold peaked at about $2,000 an ounce in very early 22, but after that it started to pull back, and this was primarily driven by the rise in real yields. So here we are going to look at a weekly chart for gold versus the US 10-year yield. So just to be mindful, what I showed here was a chart for real yields, which is the 10-year bond yield adjusted for inflation. Whereas on this chart, we're just looking at the actual bond yield itself that is not adjusted for inflation. Okay, so, right. So as you can see, after the Russian invasion, the price of gold peaked above $2,000, but after that, it started heading lower. You would think that after that, because of a crisis or geopolitical risk, that the price of gold should remain elevated. It did spike, but however, ultimately, the fundamental story took over, which basically meant that as bond yields started to rise, they become a more attractive hedge against inflation versus gold. So this is what this story, or these two charts, are telling us. So when inflation is high and bond yields are high, bonds become a preferred asset for investors to hedge their positions. So that's when gold becomes less attractive and was started selling off. So similarly here, the 10-year bond yield rose very strongly from 3% to go as high as just above 4%, and the gold bottomed at about 1600. So during this period, it's also important to note that financial conditions were also tightening. So that meant the dollar index was strengthening while bond yields were rising. So these two components also affect the price of gold, right? So a stronger dollar, stronger yield are going to negatively impact the price of gold. And what happened towards the end of 2022 was, as we mentioned earlier, the dollar index started to pull back quite sharply, and also bond yields started to retreat, although they were still relatively high, or based on historical levels, it's still relatively high. But because of the falling dollar and also expectations that the Fed was not going to be very aggressive, gold started to become a much better hedge against inflation. So with falling dollar, falling DXY, and falling bond yields, gold actually started to bounce from 1,600 and started moving up and hitting as high as $2,000 per ounce. So moving forward, what we can take away from this, okay, sorry, this is a weekly chart. Yeah, so what we can take away from this is, it is important to take note of where bond yields are trading, where the dollar index is trading. Are they both strengthening? If they are they going to, it's quite likely that they will impact the price of gold and drive it lower, as what we've seen. And conversely, if bond yields are falling and the dollar index is weak, it means that financial conditions are loosening, and we could potentially see the price in gold move up. So because inflation is still relatively high in this period, whereas the dollar index is falling and bond yields are falling, gold becomes a better hedge against inflation versus bonds. So that is why we've seen this move up in gold prices as well. So now if we look at a live chart for gold, so this is XAU USD on a daily time frame. So you can see that yes, once gold bottomed at about, okay, on this here, it's trading at the bottom was about 1,800. It went as high as 2010, right? So now we know that as bond yields fall, the dollar index fall, these are catalysts for gold prices to move higher while inflation is still high. So some of the key levels to take note for gold this week would be the first resistance of 2009, the first support at 1,933, which is also at the 38.2% Fibonacci retracement level. The second support would be at 1,900. Okay. If we go back to our charts. Okay, so we will end the webinar by looking at this week's calendar. So as I've shown you on Forex Factory, how to access the calendar and how to filter, how to apply the filters to look for the economic data events that would be of interest for you. So as you can see this week, we have in the US, the ISM manufacturing PMI survey being released. So this will tell us the state of the manufacturing industries in the US. And we also have, as I mentioned at the start, we have two cash rate announcements by two central banks. So the Australian Central Bank and the New Zealand Reserve Bank, RBA's Reserve Bank of Australia, RBNZ is Reserve Bank of New Zealand. So these two would be key news events to watch out for, and they'll probably have quite a significant impact on the relevant currency pairs. And then also we have some employment data coming up in the US as well. So we have ADP non-farm employment data on Wednesday, and followed by the ISM Services PMI report. Please note these times are all UTC +8. So when you are searching Forex Factory and applying the filters, you are able to adjust the time zone as well. So you can set everything up according to your time zone and your preferred countries that you look, or news events from the countries that you would like to look forward to. And finally, on Friday, 8:30 p.m. Singapore time, we'll have the non-farm employment report plus the unemployment rate release. So the non-farm employment change report is one of the critical news events that will be coming out this week. So it'll be important to see how these numbers affect markets, be it the dollar index or currency pairs, and also equity markets as well. So I hope this has been a good session for you. We've covered quite a few things today, right? We've looked at the production cuts, surprise production cuts by Saudi and its OPEC and non-OPEC members with regards to oil production. We've also seen this supply disruptions coming from Iraq and Turkey last week that have, these two catalysts have pushed up the price of oil quite significantly. And moving forward, it'll be important to know, to pay attention of how the weekly stockpiles by the EIA will come out. So if we continue to see the EIA stockpiles continue to draw down, you can expect oil prices to stay elevated and probably move higher as well. Right, and we've also looked at the equity markets. We've covered gold as well. So just take note of, to sum up, I would say just take note of the major economic events that are coming out this week, and also pay attention to US bond yields and the dollar index, as this will help you to guide this will help guide us in terms of the direction for gold, equities, and various currency pairs. Right, okay, I'm just going to check if there were any other questions. Okay, I don't think I see any other questions. Yeah, let me see anything else. No. Okay, if if that was, I think that's it. I don't think if we've had any other questions. I hope this has been a very informative session for you guys, and we look forward to seeing you for the next one. All right, thank you and have a good trading week, everyone. Bye bye.